I wanted to share a video on how I go about looking at an earnings trade specifically, and give you an idea of the process that I walk through when I start looking at a particular stock that's going to be reporting. The example that I will use in this video is Philip Van Heusen, which reports on Wednesday. So the first thing I do is take a look at the chart, and let me try to share it to show what I'm looking at. Earlier this morning I posted a couple of different perspectives on this chart. One showing a declining trend line through here, and the other perspective showing a resistance line that's running through here at the 120 price level. This was the earnings reaction from the prior earnings report, and so you have a pretty decent move from near a 130 close to close at 120, so a $10 move. So it's got the capability of moving that much. When I look at the option chain, it only has monthly, so this is for September expiration, which would be 2 weeks from this Friday. So you basically have 14 trading days if you were going to use this expiration to put a trade on. One of the things that I always look at is what's the top open interest. And I'm using Google Finance here because anyone would be able to look at the same chain that I'm using versus trying to use the actual option chain view from the particular brokerage account that I would be using for the actual trade. So I'm trying to use something that would be commonly available to anyone that would be viewing this video. As you can see, the 115 call strike, it's just over 10,000 contracts in open interest. And so my expectation is that traders are leaning more bullish as this heads into earnings. Or this may have been trades that were put on without even the consideration for earnings. That's very possible. So what I do, once I do this part of the review, the chart and the option chain, is I decide on what my own bias is going to be, if any. And in this case, I think I'm going to go ahead and lean bullish given the amount of open interest that is on the call side. So with that in mind, the typical approach that I would take here is I would use a call ratio and short some puts to try to make the cost as near free as possible, and in some cases even get a credit, which I think I may be able to do here. So let me share my spreadsheet that I use to track some of the basic information for earnings. This is just where I report the ticker. This happens to be current Wall Street consensus, EPS, and revenue. This is the date and the time of the day that it's going to report. And here is the particular trade that I like. You're essentially going long the September 120 calls, and you are shorting the 125 and the 130 calls on a 1-to-2 ratio, and then short the 105 puts. And as of the close Friday, this trade would pay a 40-cent credit. Another way to look at this trade to help visualize how this would work is this trade. You would essentially be long the 120-125 call spread, and you would be short the 130-105 strangle. And the idea here is having the credit is very nice, because in case the market decides that it wasn't bullish, or it just chops, or maybe even drops $10 from here, you're going to want that little bit of a credit just for being able to participate in the trade. Now, if it does, in fact, have a good report and the market reacts favorably, as long as it stays away from the 130 strike, you will be able to get $5 for that call spread if the price is in between 125 and 130 at expiration. So you get a 40-cent credit, and the max reward is going to be $5 here. One additional thing that I will note is the 105 strike. You would have to be comfortable owning there, or knowing that at expiration you would roll those short puts down if price does get under that strike. And that's it for this video on PVH.